Ngatia Kirungie, and I am the head of the Kenya Pension Fund Investment Consortium Secretariat. And I would like to welcome and thank everyone for joining us this morning at our inaugural KEPFIC Infrastructure Investment Series event, which will run from 9 a.m. to just before noon. I think you can see the program in front of you. Today's focus will be to learn more about a compelling infrastructure investment opportunity in the road sector, which is being driven by Stanbic Bank and guaranteed by Garantco. In addition, we shall hear from three critical KEPFIC stakeholders. First, the pension fund regulator, followed by the Fund Managers Association, both of who will provide some remarks on pension fund investments into infrastructure and alternative assets. And we will also hear from KEPFIC partners, MiDA and the World Bank, who are supporting KEPFIC with transaction advisory services and independent assessment of KEPFIC opportunities, as well as trustee capacity building. But to kick things off, let me hand over the floor to Mr. Sundeep Raichura, the chairman of KEPFIC and CEO of Zamara, who together with a number of other trustees within our steering committee was instrumental in the formation of KEPFIC. So over to you, Sundeep. Thank you.
Hey, thank you very much again, Ngatia. Good morning, everybody, and a very warm welcome to our virtual event today. It is good to see online a number of trustees of retirement funds who are members or potential members of KEPFIC who have joined this event. We are also very privileged this morning to have Mr. Nzomo Mutuku, the CEO of the Retirement Benefits Authority, our industry regulator, also join us, as well as many distinguished participants from Kenya and indeed abroad also join this event. As Ngatia mentioned, today's event is the first of a number of investment events we will be holding and hosting for members of KEPFIC to showcase investment opportunities that we can collectively take advantage of. And ladies and gentlemen, this is very much in line with our core promise as KEPFIC of providing pension funds in Kenya with access to compelling investment opportunities in the alternative asset space. For the benefit of those of you who have not attended KEPFIC events before, the Kenya Pension Fund Investment Consortium is an initiative by pension funds in Kenya for pension funds. This is an initiative that enables pension fund trustees to work together and collaborate on making investment in alternative asset classes. And we appreciate the challenges faced by trustees in diversifying their investments into alternative assets, particularly things like infrastructure. These investments, by their very nature, are complex, they require costly due diligence, large investment outlays that can be beyond the capacities and even the regulatory limits for many of our individual schemes. The approach of collaborating in making investments that membership of KEPFIC offers enables us all to benefit from a sharing of technical resources, achieve economies of scale, lower our risks of investment, and also importantly have a higher bargaining power so that we can get better deals and hence better returns for the members of our pension funds. We as KEPFIC, we are also an anchor investor for global pension funds who are looking to invest in Kenya and Africa. And to this end, as many of you will be aware, as KEPFIC, we have a memorandum of understanding with MiDA advisors to enable pension funds in the US and other institutional investors to co-invest together with us. I'm also very pleased that in the next week or so, we will be signing an MOU with the CMA and the NSE on how we can work together. I think it's also very important for me to clarify that as KEPFIC, we are not a fund manager. But in fact, we work very closely with the fund managers of the pension funds who are our members when assessing investment opportunities. We collaborate with our fund managers, and I'm really delighted this morning that we have the chairman of the Fund Managers Association, Jonathan Stichbury, who is very supportive of our initiative, who will also be making some remarks to us today. And I should also add that beyond access to investment opportunities, there are very many other benefits to a pension fund being a member of KEPFIC. These include trustee capacity building initiatives, investment support from our partners, the World Bank, MiDA advisors, the USAID, the benefit of pooling of funds, which enables even smaller funds to participate in infrastructure investments. And also the greater collaboration between pension schemes enables us to also be an advocate of the interest of the pensions industry as well as the members of our pension funds. And today, as Ngatia said, we will be looking at the first of several infra investment opportunities that have been identified and independently assessed through the support of our partners, including the World Bank, MiDA, and the USAID. And I would say that assessing live investment opportunities is a very powerful way to build our collective investment knowledge. And we look forward to hosting many further events in the future. So ladies and gentlemen, to conclude, KEPFIC is a sign of the maturity of the pensions industry in Kenya. And this is a model that many other countries in Africa and indeed the world are looking to emulate. We can be real trailblazers in Africa. And if, as a pension fund, you are not a member of KEPFIC, then please do join. We will be very happy to come and meet you, meet the full board of trustees, and talk to you about what we can achieve together for the benefit of our members, as well as to play a role in nation building. So on that note, thank you very much again. Thank you for making time to join this event. Back to you, Ngatia.
Thank you. Thank you very much, Sundeep. Moving along swiftly, we'll take you through a very brief presentation on KEPFIC and how we got to where we are with the opportunities that we will be showing you over the next couple of quarters, starting today, of course, with the road opportunity. Allow me to share my screen. So to start off with, just as Sundeep has mentioned, KEPFIC is a consortium of local pension schemes, both in the private and public sector, that have come together to jointly collaborate on long-term infrastructure and alternative investments in the region. And alternative investments represent a significantly untapped opportunity for pension fund portfolios, as I'm sure we'll hear the fund managers speak about. We aim to mobilize and invest over 25 billion shillings in these infrastructure and alternative assets, and we aim to provide competitive returns and diversification opportunities for our members while building their technical and investment capacity and being the collective voice representing you, the pension funds, on policy and regulatory matters. A quick recap. So we were officially launched last year in October 2020 at the Movenpick Hotel. It was a hybrid event where we had some people in physical attendance as well as an online audience via Zoom. We had a very high-profile list of speakers, including the former U.S. Ambassador to Kenya, Mr. Kyle Makata. We had the PS National Treasury, Dr. Julius Muya, as well as our regulator, the CEO of the Retirement Benefits Authority, Mr. Nzomo Mutuku. And the recordings of both the launch as well as the investment conference, which followed a few days after, are available at our website, kepfic.co.ke, and I highly encourage everyone to take a look. Sundeep mentioned that we have key support partners. These include USAID through Palladium and the Kenya Investment Mechanism. We have the World Bank Group, and we have MiDA advisors. And KEPFIC has been recognized as one of the top pension fund infrastructure initiatives within the continent. And I can tell you definitively that the pension schemes in Southern Africa as well as West Africa have seen what we have been able to achieve in our very short time and are looking to emulate the same. So they're also forming their own pension fund consortiums to look into infrastructure opportunities. Sundeep mentioned that KEPFIC is an organization that was created by pension schemes for pension schemes. And I think that's very clear when you look at our steering and investment committee in front of you. You can see that these are all familiar faces. They are trustees or investment professionals. And so that makes it clear that we are very well versed on what the needs of the pension fund community are, and you're very well represented within these two committees. Before we go any further, why do we believe that infrastructure is a compelling asset class for pension fund portfolios? Well, very simply put, is what you can see in front of you, those 4 reasons. The first is that infrastructure investments offer very competitive returns and reliable cash flows. We would not be having this discussion if that wasn't the case. Secondly, infrastructure provides significant diversification potential, opportunities for you as pension schemes to look beyond just traditional asset classes of, typically stocks and bonds, which is much needed right now. Further, infrastructure by their very nature and the long-term maturities allow you to match pension schemes' long-term liabilities with a long-term asset, which is very critical. And lastly, they provide an important hedge against inflation, which is especially important when you're looking at long-term investments. And that's because the revenues from infrastructure assets are usually linked to inflation. So even if inflation was to go up, your revenues would go up as well. And so your real returns remain strong. So since our launch, we have engaged with the market to find viable investment opportunities for our members. We received a lot of support from our partners, MiDA advisors and Cross-Boundary. And we had a simple wish list, which you see in front of you. These are the elements of an investment that we were looking at or looking for that we used to go and engage with the general market, with transaction advisors and project sponsors. So we were looking at opportunities primarily in Kenya, although we do have ambitions to go wider than Kenya, going to the East African region and into the greater African continent with time. But for now, we're looking at opportunities primarily in Kenya. We're looking at opportunities where we could see some kind of track record, and in the absence of track record, where we could have guarantees in place. And I'm happy to say that we've been very successful on that. We're looking for opportunities where the financing required would be in local currency, not in hard currencies, where we could actually invest our members' Kenya shillings, and where debt would be the preferred investment instrument, just given the conservative nature of our funds at the moment. I mentioned the compelling returns, so we're looking at opportunities where the returns would be higher than what you'd receive in government bonds, and we would be able to deploy this investment capital within the next 6 to 12 months for about 5+ years investment horizon. So together with MiDA and with Cross-Boundary, we engaged over 30 stakeholders. We reviewed over 17 transactions and shortlisted five potential opportunities. These are the five opportunities that we shall be bringing to the market through these investment series, starting with today, the road opportunities. The stakeholders we engaged included project sponsors, as you can see some names there, that run their own infrastructure assets, investment funds that we could co-invest with, commercial banks that provide financing for these infrastructure opportunities, as well as investment advisors. But I would like to add that we would also be looking for opportunities from the pension schemes themselves. So it's not just that we'd be looking at bringing outside investments to pension schemes, but there are a number of pension schemes that already have some infrastructure or some alternative asset exposures that we would like to, we could also help co-invest with. So the 5 opportunities, what you see in front of you, I won't spend too much time on this because we will focus on one today, but you can see they are basically split into 3 categories. The first is student housing, and I think we're all familiar with ACON and the Green Bond and their REIT that was launched recently. Then the second category or subsector of infrastructure we're looking at is transport, specifically roads. And this is where you have the Lot 3 road program that we will discuss shortly, as well as the PPP road expansion project, the Nairobi-Nakuru Highway. And finally, we have energy projects, and in this case, a power plant here in Nairobi. What I would like to say that is common amongst all these projects is that they all have relatively low complexity and are often backed by either a partial or a full guarantee, which is very important for our members. So without, I would not want to take the shine off the presentation Stanbic are about to make. So I'll stop there and stop sharing my screen. And at this point, I would like to introduce the next speaker, Mr. Nzomo Mutuku. Mr. Mutuku is the Chief Executive Officer of the Retirement Benefits Authority and an ex officio member of the Board of Directors. Prior to his appointment as the CEO, Mr. Mutuku had been seconded to the National Treasury and Planning as a Senior Advisor, Financial Sector and Acting Director, Financial and Sector Affairs Department. Previously, he was the Chief Manager, Research and Development at the RBA and has worked at the RBA since 2000 when he joined from the Central Bank of Kenya. Mr. Mutuku is a big champion of KEPFIC. He appreciates the work that we have done from our inception when KEPFIC was just a noble idea, and we appreciate you, Mr. Mutuku, and welcome. Asante.
Thank you, Ngatia. Good morning, everyone. The chairman of KEPFIC, the steering and investment committee members, the KEPFIC secretary team, distinguished scheme trustees in attendance. Once again, good morning. I'm indeed happy to be here. I am a big supporter of KEPFIC and alternative investments by schemes generally. And therefore, I'm very happy to be here and to hear that you're going to be listening to some very specific proposals for investment. That is very good news to us in the regulator. Let me start by saying that it has been a tough time for our industry. Last year we did see a lot of challenges coming out of the COVID pandemic. But nevertheless, I think our industry has proved to be pretty strong and resilient. Overall, we saw growth of around from 1.29 trillion to 1.39 trillion, to growth of around 100 billion in terms of scheme assets, which was very encouraging because we had so many shocks hitting our industry. We had people withdrawing, we had employers suspending contributions, and of course we had the investment side not performing well. So we are happy that at least last year we were able to register that growth. This year we seem to be off to a good start from what we are seeing in the markets, and also we have seen a lot of employers who had suspended contributions come back to making contributions. So we are very happy and we are positive that it's going to be a good year. But I think despite the growth that we saw last year, as a regulator, we are concerned about reducing diversification of our investment portfolio. Just to give you some examples, if you go back to 2018, government securities was around 39% of our portfolio. It went up to 41% in 2019, 42% or 44% in 2020, June, and now it's at 45%. So you can see increasing sort of movement to more of government securities. Also the guaranteed funds, which used to be 14% and are around 17%. Equities has come down a bit, but primarily, I guess, because of the valuations that we saw. So we have seen move towards more traditional asset classes. If you look at corporate bonds, at one time we were at 5% in terms of corporate bonds investment. Now we are at 0.38%. If you look at offshore, we used to be at around 2%, but we are at 0.8%. So perhaps the only alternative that has been growing is a private equity class, which has come up from 0.07 in 2018 to around 0.12 now. Quite huge growth in that class. REITs is also down from 0.06 to 0.02. So I think the point I'm trying to make is that we need more diversification. We need more assets coming on board. And this was the reason why last year we did introduce a new asset class for infrastructure, so that schemes could now also diversify into this new area. But of course, we'd want them to diversify into this area through appropriate instruments, particularly debt instruments, as has been mentioned. And therefore, I think KEPFIC is really timely because KEPFIC is all about investing in alternative assets. That is where we are very supportive, and we're happy of the good progress that has been made since we had that launch event back in October at the Movenpick. So we look forward to KEPFIC continuing to promote scheme investment in infrastructure and other alternative investments, and also increasing capacity of trustees and understanding of trustees in these areas, particularly through this kind of forums where we have experts coming to talk to us about some of these investments. So I think that is very encouraging. I'm also happy that I'm seeing KEPFIC expanding to smaller schemes. I remember in the beginning it was really the big boys, but we are now seeing more interest and reaching out to smaller schemes, which is good because the more that we have on board, the better. So we're happy to see more people coming on board from some of the smaller schemes. So like I said, we have the new investment category. Of course, currently take up for that one is 0. So we are hoping to see some activity there. And this perhaps will be one of the vehicles that we can use to have schemes now moving into that area. I'm also very happy to see that KEPFIC has been able to get a lot of support from different international partners. I know USAID is supporting. We have seen World Bank supporting, MiDA, and so on. So that is very good because, of course, we also need to learn from international practice and see what is happening in other jurisdictions, which, of course, have been investing in infrastructure for many years. I think with those remarks, I just want to wish all a good meeting. Of course, I will not attend the last session where you will be talking about the actual investment, but I wish you a good discussions. I also really want to commend KEPFIC for bringing on board, the Fund Managers Association, because it's very critical that the fund managers play their role under the law in terms of approval of investments. So we are happy that Jonathan and the FMA team are here. So thank you very much. Thanks for inviting us. We look forward to more interaction with KEPFIC and continued growth of our industry. So thank you, and I'll stop there.
Thank you very much, Mr. Mutuku, for your comments. At this point, I would like to introduce Mr. Jonathan Stichbury. Jonathan is the chair of the Fund Managers Association, whose vision is to promote responsible and sustainable investment and to responsibly protect and grow the investment industry for the benefit of all stakeholders. Jonathan is also the Managing Director and Chief Executive Officer of Sanlam Investments East Africa, where he joined as the CEO in 2000. Sanlam Investments was formerly known as PineBridge Investments, and during his tenure, Sanlam Investments has grown to become one of the largest pension fund managers in both Kenya and in Uganda, with client assets under management in excess of 350 billion shillings. Jonathan graduated from the Royal Military Academy in Sandhurst in 1984 and subsequently received a postgraduate diploma in investment analysis from the University of Stirling. He was made an associate member of the UK Society of Investment Professionals and is currently the chair of the Fund Managers Association, as I mentioned. He's also a member of the Institute of Certified Investment and Financial Analysts, ICIFA. Over to you, Jonathan. Thank you.
Thank you, and good morning, ladies and gentlemen. Could someone just confirm, first of all, that they can see and hear me?
Yes, we can, Jonathan, loud and clear.
Wonderful, thank you very much. Well, good morning, Chairman, Secretariat, distinguished attendees. Thank you for this opportunity to speak to you today. I speak as the Chairman, as has been mentioned, of the Fund Managers Association. Not everyone on the meeting today will probably be aware of the FMA, so if I could just spend 1 minute explaining who we are and what we do. We're a trade association established over a decade ago. We're open only to CMA licensed fund management firms, which manage between them in excess of £1 trillion Kenyan shillings. We have 15 members and they collectively manage over 95% of Kenya's pension and CMA regulated collective investment schemes assets. By investing throughout East Africa, FMA members contribute to the growth, development and sustainability of Kenya's capital markets and its underlying economy. And this includes investing in alternative and infrastructure assets. Clearly, as an industry association, one of our roles is to lobby on behalf of clients and the industry, but very importantly, the FMA seeks to promote the highest professional standards in terms of integrity and ethical conduct amongst its members. And in fact, a prerequisite of joining in the FMA is that potential members must agree to comply with the CFA Institute Asset Manager Code. And I'm pleased to say that approximately 100 CIFA certified professionals are currently employed by FMA member firms. Thank you. Turning now to KEPFIC. The FMA very much supports KEPFIC's mission to provide local pension schemes with greater access to alternative assets for pension schemes of all sizes, as we mentioned, and I'll come back to that. We also support the trustee capacity building offerings and provide investment support, and the investment support which has been provided by independent experts from partners such as the World Bank and USAID. And we have worked with these institutions over the past few years as we have attempted to build out these offerings in Kenya. Further, the FMA has been represented on KEPFIC's investment committee by a couple of our CEOs, and one of our members, our former members, currently is the chair of KEPFIC's investment committee. So it's been, it's been a working relationship and one that we've been keen to support. And I think the reasons for our support are obvious, but I think they're worth mentioning. First of all, pension schemes are the largest pool of long-term captive capital in Kenya. And I think no one on this call would deny that Kenya needs infrastructure development. And it makes perfect sense, therefore, for pension funds to finance that development, after appropriate due diligence, of course, and whenever the investment opportunity makes sense. The second thing is that pension schemes in Kenya are generally not well diversified. They typically have an over-reliance on returns from fixed income securities, and whilst those returns have been reasonable, nevertheless, it's never good to have all your eggs in one basket. So there's a definite need for pension schemes to invest in alternative asset opportunities, which are well structured, have compelling returns. And of course, one of the benefits of that is that infrastructure opportunities have long-term cash flows, and pension schemes require those. Pension schemes have to think 20, 25 years into the future, not about next week or next year. So these infrastructure initiatives can also provide much needed portfolio diversification benefits. But one of the other things we particularly like about KEPFIC is that at the moment, realistically, only large schemes can consider investing in some of the alternative assets that are available. And what I mean by that is when a private equity fund is raising capital, quite often they will have a minimum, what they call ticket size, of $5 or $10 or even $20 million. And of course, there are very few schemes in Kenya which are large enough to make those type of investments. So KEPFIC offers an opportunity for small schemes to come together in a managed, aggregated arrangement And I think this is really important and very much to be commended. Furthermore, KEPFIC understands the needs of pension fund trustees. They understand the need for capital preservation, and they also understand how the RBA regulations work in practice and how to work with fund managers. But just to be clear, KEPFIC is not a fund manager, it's an association of pension schemes. And I know the Secretariat has been keen to point this out on a number of occasions. So what that means is the fund manager's role remains the same, which in this regard is to advise their clients on the suitability of potential investments for their respective client funds. Now, it will not always be the case that every alternative asset opportunity is a good fit for each scheme. And as always, it will be up to fund managers to determine the ultimate suitability of these investment opportunities for their respective clients, because much will depend on the fund's risk profile and their liquidity needs. But in summary, and in conclusion, I think it's incredibly useful that KEPFIC has come into being. It provides a wonderful opportunity for schemes of all sizes to access a potential pipeline of investment opportunities in the future, and hopefully help support our country. Thank you very much.
Thank you very much, Jonathan. We are now going to, right before we would like to take you through, would like to show you a short KEPFIC video, but before which we shall have a few poll questions for the attendees. The first question being, and I'm not sure that it's up yet. Yep. The first question being, were you aware that the RBA, our regulator, recently introduced infrastructure as a distinct investment category under the pension fund investment regulations? Mr. Mutuku spoke about that, which now allows pension schemes to invest up to 10% of their assets into this new asset class. And the second question speaks to the benefits of infrastructure that I mentioned in my short presentation, which have been listed there, A to E. So we would like you to all please select which of the 5 you believe to be most desirable to your scheme or organization. Let's take a couple of minutes just to answer that before we go into the video.
In the search for optimal returns, Kenyan pension funds, like those the world over, continue to scout for profitable and impactful investment opportunities. While most pension funds have traditionally invested in government securities and blue chip stocks, investments in infrastructure and other alternative asset classes present an innovative, profitable, and long-term sustainable opportunity. The Kenya Pension Funds Investment Consortium, KEPFIC, is a consortium of Kenyan retirement benefit funds that have come together to make long-term infrastructure and alternative asset investments in the region. Infrastructure investments offer attractive returns, portfolio diversification benefits, and match long-term assets to long-term liabilities. And over the next 5 years, KEPFIC aims to mobilize $250 million from Kenyan pension funds and offshore co-investors for investment in impactful infrastructure assets. To do this, KEPFIC aims to identify suitable infrastructure opportunities, pool investment capital from local pension funds and co-investors, and build the technical and investment capacity of our member funds to enable them to make informed infrastructure investment decisions.
Infrastructure, by its very nature, is a very complex investment class. It requires costly due diligence and research, and the amounts required, or the ticket sizes, are beyond the capacities and regulatory limits for individual pension funds. And indeed, when you look at the pension fund industry in Kenya, we have 1,300 pension funds, and most of these are too small, and even the larger ones would struggle to invest in infrastructure on their own.
Kenya faces a significant infrastructure financing deficit estimated at $2.1 billion annually, a deficit that cannot be met by public resources alone. While historically infrastructure has been the domain of national and county governments, there is a significant opportunity for private sector participation as more private capital seeks longer-term steady returns, while governments are faced with much-needed competing priorities such as healthcare, food security, and education. Infrastructure presents an attractive yet underutilized investment opportunity for pension funds, and the involvement of private institutions will not only contribute to Kenya's economic growth and transformation as a whole, but also to better project governance structures by adopting global best practices. Thanks to a recent provision in the Retirement Benefits Authority investment guidelines, Kenyan pension funds can now invest up to 10% of their assets into infrastructure, effectively unlocking over $1 billion into the asset class.
We have recently amended our investment guidelines to allow schemes to invest a portion of their assets in infrastructure. We are therefore very supportive of KEPFIC's mission to bring together different pension schemes and other stakeholders which are keen on investing in this area of infrastructure, and is also bringing together other stakeholders to develop the infrastructure investment agenda.
KEPFIC was recognized as the Pension Fund Infrastructure Initiative of the Year at the 2019 Africa Investor Awards held in Cape Town, South Africa, further validating its mission and shining a brighter light on the East Africa infrastructure investment opportunity globally. The consortium has also received technical support from USAID and the World Bank to help local member funds navigate the infrastructure investment terrain, and by working with the mobilizing institutional investors to develop Africa's infrastructure initiative MiDA, KEPFIC has further leveraged its mission and established a partnership with US-based pension funds with total assets under management in excess of $1 trillion to explore infrastructure co-investment opportunities in the region.
KEPFIC presents an innovative approach to investments that will catalyze critically needed sources of private sector capital for infrastructure development. This comes at a time when national and county governments are facing growing budget deficits and competing priorities in healthcare, affordable housing, education, and food security. USAID's Kenyan Investment Mechanism is pleased to partner with Kenya Pension Fund Investment Consortium to support this expanded source of new capital.
MiDA Advisors has been supporting KEPFIC in the creation of a local consortium of pension funds to invest in infrastructure. We're working under the umbrella of the U.S. Agency for International Development. Our goal is to support a strong partnership between American pension funds and Kenyan pension funds. And American pension funds need a critical partner in the region, and like-minded investors that are working for the benefit of its retirees and that are looking to undertake economically important projects in infrastructure and housing, supporting job creation and economic development in the region.
By joining KEPFIC, pension funds will participate in infrastructure investments and enjoy several benefits such as economies of scale in the infrastructure investment selection, structuring, and due diligence processes, capacity building through live deal analysis and project site tours, regular investment workshops with experts in infrastructure investment, and networking sessions with like-minded local and foreign pension funds, co-investments with global pension funds, technical support from implementation partners in the investment selection and execution process, and finally, advocacy efforts by representing its members' interests in regular engagements with regulators and external stakeholders and contributing to supportive policy measures.
Investing in infrastructure for us is an interesting asset class because it provides an opportunity for us to make a difference in the development of our country as well as other regions. What we benefit by working together as KEPFIC is access to knowledge, access to risk management, and access to partnership with other like-minded investment vehicles.
KEPFIC, mobilizing institutional capital for impactful infrastructure investments.
Now, without further ado, we get to the main part of our agenda, which is a presentation from Stanbic and Garantco on the Kenya Roads Annuity Lot 3 project bond, on the Stanbic side, we have Mr. Jonathan Muga, who is the Head of Investment Banking, Kenya. We also have Mr. Robert Murai, Head of Debt Capital Markets, Kenya, both with Stanbic Bank Kenya. And on the Garantco side, we have Mr. Samuel Chasia, the Director of Capital Markets and Business Development. Over to you, Jonathan. Thank you.
Okay, thank you everyone, and it's a pleasure to talk to you this morning on this particular transaction, Lot 3, which is part of the Annuity Fund, the Roads program, which was conceived in 2014 and has taken a while to get here, but I'm happy to provide context on the journey. I will be joined by my colleagues from Stanbic as well as the Garantco team to provide this presentation. Next slide. Yeah, so some context has been provided and on the characteristics of infrastructure as an alternative asset class. So I will not spend too much time talking about the characteristics, but on the slide, you will see some of the attributes that make infrastructure a good investment addition to portfolios, given that it's used every day, requires significant capital requirement, and which is backed by long-term contracts, and which underpin economic activity in any country, and those contracts allow it to have predictable cash flows and have characteristics that are aligned to the economy, and therefore for investors like yourselves would be a great addition to your portfolios, and in line with your investment strategy. Moving on to the next slide. So if you think about how Kenya in particular, and this is not unique to Kenya, but also a number of African countries, a lot of our infrastructure has been has been delivered through government and government-backed models. So typically what they would do is obviously use their taxes, and to the extent that they can borrow, and we've seen a lot of borrowing in the last couple of years, then they work with their bilateral partners to deliver infrastructure. But as you will all know, Kenya in particular has borrowed over the last couple of years, and what this means is that we've ended up with high debt levels, and it requires the country to now start thinking about how to deliver infrastructure through other means. PPP has become very critical in supporting government to deliver infrastructure through the private sector, and there are different models that you could use to deliver infrastructure, and they range from a better spreading out budgetary support over a number of years, but still underpinned by taxes, to models that are fully private sector supported, where you have users paying or you've got shadow payments from government. So if you look at the annuity program, it will still require some support from government, but what's been done is to ring fence those cash flows and ring fence those taxes to be able to support infrastructure. Next. Yeah, so the slide in front of you right now looks, it's a schematic of the structure of the program. And like I highlighted earlier, this is a PPP delivered through a special purpose vehicle, which will be set up by, or has already been set up in this case, by the sponsors who will have been awarded the contract. The implementing agency is KENHA, which is a road agency, and in this structure will be the contracting authority and counterparty to the project agreement. Then on top of that, you'll have a letter of support that will be provided by National Treasury and countersigned by the sector ministry, in this case, Ministry of Transport, Infrastructure and Housing. And so, as you can see from the structure there, you will have, the green part where you have the SPV concessionaire, that's the project company that will enter into a contract with the contracting authority, that's the project agreement, but will draw funds from the Roads Annuity Fund, which would be a ring-fenced fund set up in National Treasury to be able to pay for the obligations of this particular contract. So this structure is unique in a way because the contracting authority will be responsible for meeting the standards. However, National Treasury will then be responsible for making sure that the obligations are always funded and has set a fuel levy of 3 shillings per litre to be able to fund this project and 4 other projects that have been approved to operate or be implemented under this model. Next. Okay, so this is a slide that talks about the project background. Sorry, you moved a little too quickly. Yeah. So this slide shows the location of the roads as well as the project parties involved. You will see that the roads are towards the northeastern part of Kenya. There are two lots of roads, or two tranches of road. One slightly lower in Raichura and the other one in Mandera, together forming 143 kilometers. And traditionally, for those of you, historically, some of you will know that this part of Kenya has not benefited from development as much as other parts of Kenya, so is currently being prioritized for infrastructure development, and this particular project will contribute to that strategy of the national government. Right below, you will see the shareholders or the sponsors to this particular project, made up of a local sponsor group as well as a Chinese company that has got significant experience in not only construction of roads, but also maintaining roads, and currently manages over 3,000 kilometers of toll roads in China and in Asia. Next slide. Yeah, so this slide summarizes the proposition for this particular project. You've got a winning bidder that has been awarded 2 portions of road. They've been given the mandate to execute the works and maintain the roads over 10 years. You can see their shareholding, which I had highlighted earlier, and the capability of Shandong High Speed Group, which is a large SOE based out of Jinan province in China, and has got significant experience. And lastly, just the use of proceeds is really to finance the design, construction, and maintenance of this particular road, alongside funding that will come from other senior debt lenders who we are currently, and equity who we are currently working with to finalize the funding structure for the project. Next. Yeah, so it's important to highlight a number of transaction risks and mitigants. we do not shy away from saying that yes, there is a security risk. This has been thought about with the government, and ensure that if this risk were ever to materialize, there will be a number of mitigants in the project. The first mitigant would be, there will be a path to getting back money that has been invested, essentially backstopped by Government of Kenya. And then also the contractor who's going to be delivering the project has got experience working in security-prone areas. And also as project parties, there's a structure that's been put in place to make sure we have a security plan that can mitigate the inherent risk of security as much as possible, to make sure that we can deal with these events as they occur. But finally, the sovereign is through the letter of support and the project agreement is backing, is actually mitigating the security risk. Sovereign payment risk is the other big risk that we need to think about. I have articulated the flow of funds. So you start with the fuel levy, which has pretty much been part of the tax raising framework for the country over the last 20-25 years. It has been used mainly for maintenance of roads through the 3 road agencies, collected by Kenya Roads Board. What's now been done is to hive 3 shillings per litre and dedicate it to this program. And so part of the work that we've done is just to ensure that the projects that have been approved can be paid for through the fuel levy, and make sure that the fund is actually sustainable. So you will, through this structure, we think that we've covered all loopholes for funds to be used specifically for this particular project. But to the extent that anything changes during the life of the projects that have been approved, then you've got the letter of support, which is essentially a backstop from the National Treasury saying, I'll put before you a structure which is robust and will make sure that obligations are funded. To the extent that anything changes during the 10 years, here is my word as National Treasury that I will resolve that issue, and also resolve any political events that could arise from the structure not being fit for purpose. So in this way, we think we would have addressed the sovereign payment risk. Ultimately, the road needs to be built, and so the contractor needs to know what they're doing. We think that risk has also been addressed. Shandong, has done even bigger and more complex roads in difficult jurisdictions. So we have no doubt that they will deliver. But we as lenders will also appoint a lender's technical advisor to regularly review the work that's being done by the EPC contractor during construction and also during maintenance. And the EPC contracts as well as the maintenance contracts will dovetail the project agreement just to make sure that all the risks are passed down to the parties that are actually doing the work. Next. Yeah, so I'm going to stop there. That's a summary of the project structure as well as the project characteristics. So I think I will hand over to Robert and the team to talk through the next part of the presentation. Thank you.
Thank you very much, Jonathan. So in front of you is the indicative terms for the issuance. So as mentioned by Jonathan, the issuer or the sponsor will be HAS Consortium GVR Infra, which is basically a consortium formed with a local partner and Shandong, which Jonathan had mentioned, the very well-experienced company or business when it comes to infrastructure, not just on roads, but other businesses. In terms of currency, so this will be a Kenya shillings issuance. The issue will be privately placed, and the amount that we're looking for is 2 billion shillings. I think we have already engaged some of the fund managers in this transaction, but it's great to see that we also have the pension schemes, to look at this. In terms of the purpose, and as mentioned by Jonathan, the funds will be used to finance the design, construction, and maintenance of the Lot 3 projects, so the 2 roads that Jonathan had mentioned before. In terms of the funding of the transaction, so as mentioned before by Jonathan, it will be annuity payments from the Roads Annuity Fund. And as he had said, the fund is ring-fenced, which brings great comfort because, what this means is that, the Treasury or any government agency, cannot, have access to these funds. These funds are specifically for the roads within the road projects within the road program or Road Annuity Fund. In terms of the tenor, so this will be an 8-year issuance with the intention for that to be principal payments during the life of the bond. Based off our calculations, the weighted average life will actually be about 4 years. In terms of the payment of interest, so it will be fixed rate quarterly repayments. So I guess a bit shorter than a typical treasury bonds, which is semi-annual. The structure will be subordinated. In terms of pricing, so the benchmark to be used will be the 8-year government infrastructure bond, and the reason for this is that this has an armored structure, so it will fit quite nicely just in terms of the profile for the actual issuance that we're talking about. In terms of the indicative margin, so we're looking at a margin of about 30 bips above the 8-year infrastructure bond. Obviously, at the point that we issue, that's when we'll firm up on the exact pricing, because obviously the 8-year government infrastructure bond is not a static price, and there are always price movements. Probably of most interest to some of you on here is that there will be a credit enhancement of 100% guarantee of principal and interest from Garantco, which is rated AA- by Fitch and A1 Moody's. For some of you that may recall, Garantco had guaranteed 50% of the first green bond issuance in Kenya, and that was by Aecon in 2019. So this will be the second big transaction that they'll be coming back into the market 2 years after the Aecon transaction. I think one thing to think about is from a notorious perspective, or from your perspective, you won't be taking government risk, you'll be taking contractor risk or even security risk. The risk that you'll be facing is Garantco in the event of a default in principal or interest. We think this structure really provides great comfort to the investors. Just because of this, the status of Garantco and the fact that there are a lot of security packages that have been thought in terms of just making this attractive to investors. The overall idea is that this won't be the first transaction. So, because it's the first transaction, and probably for most of the pension schemes here and pension funds or fund managers, this will be the first investment into road infrastructure. So, so as to get the comfort from investors, there is 100% guarantee from Garantco. But as we look at more projects, this could come down, based on the success of this particular one. And later on, my colleague, or rather Sam Chassi of Garantco, will touch on the features of the guarantee that we're offering and how it works. In terms of monitoring, so as mentioned by Jonathan, there will be an independent technical advisor just to ensure that the road projects are done as promised, and just make sure that everything's on the ground and everything's actually being done. And then finally, from an RBA classification, so we have engaged the RBA, Nzomo, as you had seen earlier on this investment series. So the bond will be classified as either any other assets or as debt instruments for financing infrastructure. We've actually already gotten an approval on the classification for this transaction from the IBA. So we do also have a lot of regulator support. Now, before we move on to to Garantco, for Sam to just talk about the features. Number one, just an overview of Garantco, what they've done, then the features for this particular transaction. I think just one thing to note from a Stanbic perspective is that when it comes to the placing of the notes, there will be 3 people involved. So there'll be myself, Robert Murai. So then Stanbic Kenya, head of DSM. Then we also have Mark Khalil, who's the head of bond syndicate for Africa regions for the bank. And then finally, Greg Waweru, who is the head of SP Securities. So we will be the 3 main contacts when it comes to discussions on the transaction and on pricing. So having said that, I'll just hand over to Sam of Garantco to just go into the particulars of Garantco themselves and also the features of this particular transaction. So Sam, please go ahead.
Hello, can you hear me?
Yes, we can hear you, Sam.
Okay, good. Yeah, sorry. Again, yeah, I seem to be having problems with the background, but yeah, thanks, Robert, for that introduction, and good morning, everybody, and welcome to this presentation. I think what we Garantco is obviously very proud to be kind of involved in this process, and has been kind of involved in this particular transaction actually for over 2 years. So we've basically spent quite a bit of time, making ourselves familiar with this transaction, doing a lot of work in terms of due diligence and getting to understand the transaction in depth. And the reason why we do this, and just stepping back a little bit about what Garantco is actually a guarantee fund that basically our objective and mandate is to basically encourage private sector investments in infrastructure in developing countries, primarily in Asia and Africa. And we've been doing this for over 15 years. And just a quick kind of snapshot of who Garantco is. We are really highly rated. We have a AA- rating from Fitch and an A1 rating from Moody's, and we also have a couple of AAA rated ratings in Africa. Obviously, since our rating is kind of internationally highly rated, in most of the jurisdictions that we provide guarantees, our local ratings are usually AAA. And so that, on the strength of that guarantee, we are basically able to go out and provide guarantees to beneficiaries and to encourage them to kind of invest in infrastructure. And the reason, for example, that we are very interested in this transaction is we wanted to make sure that we basically have local participation in road projects, and that is what we want to kind of encourage more and more. So, as Robert explained, our goal here obviously is to get the institutional investors interested in the infrastructure in this asset class, and over time allow them to basically begin taking these risks without our guarantee, and that's kind of what our ultimate goal is. Our funders, as you can see in this slide here, is a combination of 8 European the development agencies, as well as Canada and Australia. And so they've kind of put some capital together, which I'll talk about here a little bit. And on the back of that capital, we are now able to go out and actually provide these guarantees that allow this infrastructure projects to basically be come into existence. And that is what our mandate basically is. Just the kind of products we provide. We provide a variety of particular products, from kind of partial credit guarantees to tenor extension, liquidity extension, EPC contract guarantees, and portfolio guarantees. And again, our kind of strength is the ability to kind of tailor make our solutions to the particular problem that we are facing here. And so we are very, very flexible and innovative in terms of trying to make sure we actually meet the needs of the different projects in the different countries that we are. Just again, one background, what Garantco is part of what we call the Private Infrastructure Development Group. And again, that is kind of the umbrella company that provides the funding through these different funders. And so the page is actually our parent, and basically we are one of the different solutions that are involved in the page family of companies. Okay, next slide. So just in terms of our funding, I know that there are always questions about how are we able to do what we are. Like I said, we have different funding from different agencies, and on the strength of those funders, our rating is in large part part of that. Is part kind of a reflection of the strength of our funders. And so, just in terms of the funding mix, we basically have about $1.6 billion worth of capacity given our capital base right now. So that capital is a function of kind of core capital, which is about $300 million, and that is from the different partners that are involved. We also have some callable capital. That means as capital that's kind of can be called if and when it's needed. So we have about 40 million pounds. That comes predominantly from the UK government. And then we also have some other about committed funding that's kind of coming in the future, which is about $95 million. I mean, $95 million, $95 million, depending on how you look at it. And then finally, we have some leveraged debt facilities that we made available. That is basically from FMO, AFD, and the Canadian government, and that comes to about $170 million. So the overall kind of capital that is available to us is about $600 million, and on the strength of that, we can leverage that about 3 times, and that's how I say we come to that $1.6 billion in capital. Our portfolio to date is about $800 to $900 million, so we still have quite a bit of capacity to go, and we are constantly actually raising more capital, obviously, as we try and meet the needs in the different jurisdictions that we are in. So we have quite a bit of capacity, and we keep growing that, as obviously the need for infrastructure in the countries that we are involved in is actually quite huge. So that is kind of the backing, and that's what allows us to have the kind of high rating that we have right now as Garanco. Okay, next slide. So again, I think what we try and do here, and I think this is one of the things that we I'd like to highlight here as we talk to different beneficiaries of our guarantee. Again, our role here obviously is to catalyze private sector investment into infrastructure, and I think as we mentioned before, the only way that can happen is kind of what we call kind of blended financing model. So we basically have a combination of private sector funding as well as public sector support, and that is kind of really exemplified in what we do over here. So we are able to basically, through our guarantee product, like I said, $1.6 billion worth of capacity. That allows us to kind of go out there and kind of catalyze private sector investment in the different jurisdictions that we are involved in. So right now we've actually done close to $5 billion worth of private sector investment, and that is again our goal over here. And so for example, in this particular situation, we are obviously trying to make sure that on the back of our guarantee, we are able to actually help in the deployment of over 170 million worth of investment by deploying our guarantees to do that. And so it was very, very effective for us to be able to obviously work with local pension funds and local fund managers to make sure that we can actually get this funding that is required for this particular transaction. And I think that way it actually made the kind of this particular road project be able to be viable. So just kind of as I finish here, just a couple of salient features here of our guarantee. Like I said, we're providing 100% guarantee to this particular bond raise. So what the investors in this particular bond will be facing is the risk of Garanco directly. We have, because of that, we basically take the view that we are potentially going to be a lender, and so we have spent quite a bit of time, and Jonathan and Robert can attest to this. We've been kind of involved in this project for close to 2 years now. We've done a lot of technical as well as legal due diligence. as well as also kind of all of KYC issues. I know those are some of the questions that were being asked. So we spent quite a bit of time making ourselves comfortable with this investment, and we can make everybody kind of satisfied that yes, we've done a lot of work in making sure that this particular investment, number one, is viable, number two, is vetted and kind of has no potential issues. And number three, again, we are comfortable taking this particular risk. So that is the reason why we're able to give this 100% guarantee. Our guarantee works very simply. It's an irrevocable and on-demand guarantee, meaning that if for any reason the particular project is not able to fulfill its obligations under the note agreements, we will basically pay the beneficiary and basically step in the shoes of the lender here and now pursue the borrower in that particular situation. So this is not our product is not an insurance product. We don't require that the beneficiary actually shows us that they've experienced a loss. We basically, as soon as there's a breach in the note documents, whether it's a cash flow issue, a non-cash flow issue, we will step in within 15 days and basically be able to pay out and the beneficiaries can fall away, and then we'll kind of continue as a lender and kind of pursue the transaction. So again, very, very simple guarantee. We try and make it very straightforward and easy so that yes, we can allow basically the investors to on the one hand, get exposure and understand this type of projects, because I think the need for those is actually quite high in our country. And so over time, we basically hope that we can, again, as investors get more familiar with these structures, they can actually begin demanding less of a guarantee and hopefully at one time actually be able to invest in these particular transactions directly. And we are very glad that, for example, the framework to allow this type of investments is actually happening in the local context. So we're very excited to be involved in this transaction, and we look forward to engaging with the investors as we kind of proceed to the ultimate placement and closing of this transaction. So thank you very much.
Thank you very much, Sam. I'll just move on to the next steps. So the next steps is we'll await for the fund managers of pension schemes to communicate indicative interest on the size and terms by the end of this month. As mentioned before, we think the structure is very robust, and the credit enhancement, probably makes this the safest transaction that any investor can put the capital in. From a documentation perspective, so we are almost finalizing with the note documents. So once they're finalized and executed, then we will share this with the potential investors. During this time, we'd also still be accepting various indicative commitments. Obviously, we say indicative because at the point that we do finalize or share the executed documents, the commitments from the investors and pension schemes would be indicative. Once we have received firm commitments from the investors, then there will be a process of basically just finalizing on all the CPs, which would include finalizing on the guarantee deed from Garantco, the letter of support from government, and everything else. And once that's in place, that is when we will approach investors to fund the entire 2 billion. This will be done all at a go, so it won't be tranched. It will be 2 billion at once. From our expectation, we will advise on the timing. So having said that, I think what we can do is perhaps open it up for any questions from the team, from the attendees on the call. So please go ahead.
Thank you, Robert. We do have one question so far, but before we get to that, maybe I can just recap what we have just heard. So we're talking about an investment opportunity that is 100% guaranteed by Garantco. And if there are any issues with payment of interest and principal, Garantco will come in and make that payment to investors. And I believe I had Sam talking about in 15 days. Garantco has a higher credit rating than government. And so by investing in this opportunity, you actually are getting a higher return than government bonds at a lower risk, which is a very compelling opportunity. Let me take the first question from Mr. Vivek Mittal. He says, good morning, congratulations, an excellent initiative. The question, which is in two parts, what is the risk-reward comparison of this road investment versus the usual government bonds that most institutional investors are familiar with? And the second part of the question is, what aspect of this transaction did you find most challenging? Over to you, Robert.
Okay, thank you very much, Ngatia. On the first part, so we're looking at about 30 basis points above the relevant government treasury bond. That's the 8-year infrastructure bond. When I last checked the secondary market trading, it was at about 10.6% levels. But obviously, as you all know, this moves quite a bit. I think that the fact that this is 100% guaranteed by Garantco, and as mentioned by Ngatia, Garantco is rated quite a bit higher than Kenya. The fact that the guarantee is irrevocable and unconditional, which means that if there is an issue between the issuer and any part of the project, it's not the investor's problem. You just need to issue a payment demand to Garantco, and they're obligated to make that payment, regardless of what the issues are. So really think the pricing is actually quite attractive when you think that the risk taking really is Garantco risk. And I think at the end of the day, as mentioned before, it's irrevocable and unconditional. On the second part being the most challenging, perhaps I can hand that over to either Jonathan or Sam.
Yeah, so I think the most, sorry, can you hear me?
Yes, we can, Jonathan. Thank you.
Yeah, look, so the most challenging part of the project or the transaction is really how long it's taken for us to get to a point where all the parties are happy with the risk allocation. I think this is just the context of PPPs and infrastructure that is structured this way being not only new as an asset class for you as investors, but for the country to just get these projects properly structured. But I think we've now landed in a good place. We've got good support, robust support from the government of Kenya, with the ring fencing structure in place. So we think going forward, this project and a few others will act as a good pilot or model for future investment in infrastructure. Thank you.
Thank you, Jonathan. Next question comes from Kennedy Muzama. The question is, have there been instances where Garantco has been required to fulfill the guaranteed obligations in the past? I believe this can be answered by Samuel.
Yeah. Thanks for that question. Yes, we have actually, our guarantee has actually been called in three occasions, and we've actually paid, I think, in the first case, and these were 2 in India and 1 in Nepal. We have a couple of projects that we're involved in, and I think we've basically paid, I think, once within 6 days, another within, I think, within 15 days. So yes, we have experience actually paying, and we're happy to share that. And remember, the fact that we are involved in the kind of jurisdictions that we are, there are a lot of risks, and that we understand, right? So, But what we do understand also is that the kind of perception of risk and the actual risk, there's a kind of a mismatch. And so what we are trying to do is bridge that gap. And we believe, for example, trying to get, let's say, investment from out of the country to invest in Mandera is daunting in itself. If there's anybody who should be, able to understand that risk as higher as they are, is people who are here in the local context. And so our goal here is to get the investing community kind of comfortable with local risks, because they're obviously best placed to understand them. And like I said, our goal ultimately is to get ourselves out of business. And so, yes, we have definitely a history of paying, but also one thing that we are also very, very active in the transactions that we're involved in. So we're not a passive type of guarantor. And so we've done a lot of work, like I said, beforehand, to make sure that, yes, we are comfortable in the event that we do have to pay. We understand the risks, and we are comfortable actually stepping into the shoes of the lender here and pursuing whatever remedies that are available to us. And that is kind of what our mandate is. So yeah, we are this is what we do. And again, we have experience actually paying out in other jurisdictions. So yeah, we can share that with you if needed. Yeah, thank you.
Thank you, Samuel. Unless there are any further questions, the floor is still open, and you can type in your question on the Q&A section on the screen. Okay, before we move on to the next speaker, and I just want to thank the Stanbic and the Grantsco team very much for all the hard work that you have done up to this point, and for bringing this opportunity to us as pension schemes early. We have noted end of June as the date that you want to receive some indicative levels of interest, both in terms of the size and any feedback on the terms. And I think together with KEPFIC, we shall work very closely with the fund managers to take these opportunities to our membership, where we can have one-on-one presentations to their secretariats, to the fund managers, and to the trustees, of course. So before we move on to the next speaker, I want to give you the results of the poll. The question of whether you are aware of the Retirement Benefits Authority introduction of infrastructure as a distinct asset class. I'm happy to report that a majority were aware, which is great news. I think the first step is the awareness that infrastructure investments are possible and have been recognized by the regulators. So we're happy to see that. And on the question of which are the most compelling features of infrastructure to you as schemes, the first came in as portfolio diversification. This is not too much of a surprise, given the comments from Mr. Mutuku and the Fund Managers Association Chairman, Jonathan Stichbury, about the much needed, the need for portfolio diversification, given that we are limited to just a handful of equities and government bonds. And second came in was the competitive returns. I mentioned that we wouldn't be doing this if the returns were not compelling. What we have just seen from this Grantsco and Stanbic driven opportunity is that it's a simple to understand structure that gives you a higher return than government bonds at a lower risk. Coming in third, fourth, and fifth were steady and predictable cash flows, which look simply like a bond, long-term asset liability matching, and finally, protection against inflation. I'm seeing there is one more question that has come up from Mr. Anthony Mulissa. The question is, what's the total cost of the 143-kilometer section of the earmarked road project, and what's the expected timeline of completion? And I hand that over to Jonathan.
Yeah, so for now we'll give you an approximate cost of the road. So the cost of the road is around about $130 or so $million. That's just the construction cost, but as you would appreciate, there are a number of other project costs that we need to take into consideration, including interest during construction, as well as some development costs. So the total cost will be slightly above that amount that I have provided to you. The construction period is 2 years for this particular project, and then it will be maintained over a period of 8 years.
Thank you very much, Jonathan. Last question is from Mr. Maina Wasieni. Please confirm the interest payment structure for the proposed offering. Also, it is fixed interest. That I can answer, yes. So no structural accommodations for inflation. Back to you, Jonathan, or to Robert.
Yeah, so I can touch on that. So the interest payments will be made quarterly, as I mentioned before. Now, in terms of the principal payments, as much as this is an 8-year transaction, the idea is that principal payments will be made over the duration of the transaction, and a fairly large amount at year 3. And that's why when we look at the weighted average life of the transaction, it's actually about 4 years. So principal is expected to be paid during the life and not just at maturity. Sorry, principal, that is.
Can you comment on the inflation adjustments or accommodations?
Okay, sure. So this will be similar to treasury bonds. So the pricing will be fixed. So there'll be no direct link to inflation. So it's going to mirror the fixed rate pricing that you typically see for treasury bonds. So there'll be an inflation, adjustment.
Great, thank you. Thank you so much, Robert. At this point, I think we should move on to the next section of, or the next item on the agenda. And I just want to confirm that we shall be sending out these presentations to all the attendees. So you can review them at your own time, digest the information. And as mentioned previously, we are happy to set up one-on-one discussions and presentations for each of you with the Stanbic and Garantco team. So at this point, we'd like to get into the independent investment assessment. I mentioned in my presentation that we have received considerable support from our partners, MiDA and the World Bank, to assess these investment opportunities from an independent lens, to assess them in terms of investment best practice specifically. And I would love to take this opportunity to invite the World Bank advisor, Mr. Gregor Patterson-Jones, to speak and to take us through the presentation. Gregor is an independent clean energy and impact investment specialist. He sits and has sat on investment committees of numerous high-profile international funds and advises numerous multilateral agencies such as the European Commission, EIB, UNDP, African Development Bank. He also advises central banks, for example, the Central Bank of Vietnam and UAE, and sovereign wealth funds on new fund establishment for both SMEs and green banking and finance. Gregor was previously managing director of the UK Green Investment Bank, which has successfully concluded over 100 individual climate finance investments, prior to which he was the CEO of SW Securities, a regulated clean energy finance firm investing in renewable energy projects and energy access projects in emerging markets. Gregor will be joined by Mr. Daniel Bond, who is a senior advisor with MiDA and is an economist with over 35 years of experience focused on the study of emerging markets countries. Dan was the chief economist for the Export-Import Bank of the United States. He was also the group vice president of Duff & Phelps Credit Rating Company and first vice president of Ambank Assurance Corporation. In recent years, Dan has served as a consultant on infrastructure financing for the World Bank and the United Nations Capital Development Fund. Over to you, Gregor and Dan. Thank you.
Thank you, Ngatia. I will actually be starting this presentation. My name is Daniel Bond, and as Ngatia said, I have several decades of experience in infrastructure finance, and I am delighted to be able to speak on this, I think, groundbreaking development in Kenya. I will be sharing a presentation, but frankly, we have already covered a lot of the information that we had in our presentation. A memo was probably sent to you earlier, where Gregor and I basically tried to summarize in a short document the key features of this offering, and in that some background information on the project itself. Now, our role in this effort as an advisory function from the World Bank and from MiDA advisors is to give you our experience drawn from years of working on similar transactions around the world. We're not providing investment advice per se. We're really just trying to give you a perspective on what is being offered here with the Lot 3 project bonds that are guaranteed by Garanco. And because a lot of our presentation has already been so effectively covered by Jonathan, Robert, and Samuel in the previous session, I would like to focus on some really general issues that have not been covered. I've worked in about 80 countries around the world over the last 30 years, primarily focusing on infrastructure finance. I have often seen project bonds similar to this to be used to finance infrastructure, not only in developed countries, but in Latin America, Asia, Eastern Europe, emerging markets in general. It is a very effective way for institutional investors, insurance companies, sovereign wealth funds, and pension funds to invest in infrastructure. And let me just say why it is an effective vehicle. Typically, these institutional investors are not like project finance banks. They don't have large staffs of people who can actually get into the project structure, understand it in detail, and be active in the management of the project. Being active means that they help to structure the financing, they monitor the financing, and if problems arise, they step in. They can work with the project sponsors to correct problems. Now, institutional investors like pension funds really do not have that capacity. Therefore, they are typically called passive investors. And as passive investors, they need to be presented with a way of investing in infrastructure that reflects this passivity, this lack of the kind of detailed investigation in all the aspects of the project that, say, a project finance bank will have. They are not prepared, in most cases, to monitor the project during its entire life. They don't have the staffing. And they normally don't have the staffing or expertise to step in if something happens and to work with the other lenders and the project sponsors to solve the problems. Therefore, project bonds, which are a very legally defined obligation to pay, which are fully explained in the offering memorandum, are more appropriate to these passive investors. And project bonds have been very successful in other parts of the world. Unfortunately, we have seen very little development of project bonds in sub-Saharan Africa. There has been a great deal of discussion about the need for this, The African Development Bank has been proposing the use of project bonds for many years, but they really haven't taken off in sub-Saharan Africa. This will be one of the very few examples of a project bond being used in sub-Saharan Africa of this type for a PPP type infrastructure project. Now, because this is so new, I feel that the reason Garanco has stepped in is they recognize that for this initial introduction to project financing, the investors, the pension funds, will need to have some outside support, both in the terms of extra protection, that is what their guarantee offers, full credit protection. And MiDA and the World Bank, and we have been also working with Cross Boundary, another advisory group, have been providing the extra advice and guidance in this process. So I think this is an opportunity for the pension funds in Kenya to be introduced to a new asset class and a new instrument. Now, although our presentation was designed to cover really what Robert and Jonathan and Samuel has already covered in detail, we were going to cover it in very general terms. I'm not going to focus on a lot of the contents of the slides that we have here. I'm going to focus instead that we're presenting in simple terms what you are faced as a pension fund investing for the first time in project finance. Now, project finance is a very special type of financing. As has been mentioned, there is a special purpose vehicle that has been formed. And when you invest in project bonds, you're investing in the funding opportunities of that SPV, that special purpose vehicle. We've already had some discussion of that, but one thing I would like to point out is that one way that people have explained project financing of this type is that you're investing in contracts, not concrete. You're not investing directly into the highway construction per se. You're actually looking at a set of contracts, and that is what controls your risk and your responsibilities and how you will get your payment. It is the contract itself. It is the contracts underlying this bond and this guarantee. Now, this introductory background material here, you'll be getting this presentation and these slides. This has really already been covered very well by Jonathan and Robert in terms of the nature of the project itself and the consortium. This portion has also been covered very well and in detail about the funds. It is important to note that this is unlike what Kenyan pension funds have seen before when the government offered infrastructure bonds. Now, the government's infrastructure bonds are not project bonds. They are a general obligation of the government of Kenya to pay. What distinguishes them from other general obligation bonds that the government typically offers on a regular basis, just straightforward government bonds, is that the funds that are being raised are to be committed to infrastructure projects. But the payment is not dependent upon those projects. Now, in project bonds, in contrast, the money is not going to the government, it's going to the special purpose vehicle that is creating the project, operating the project. Therefore, it is not typically on balance sheet for the government. It does not add to the government's debt burden. And that's very important for the government of Kenya at this point. The government of Kenya has to be concerned with this debt burden because of the credit ratings that will be applied to all of its bonds. And the government is already quite indebted. Now, the government does have an obligation, though, an obligation in the future to be making payments. Those are contingent liabilities. So there is definitely an underlying all of this, a government payment stream, but the actual debt is going to the SPV, and as the funds are used by the SPV for the construction and operation of the project, not to the government. Now, one of the things that hasn't been stressed so far, although it's been noted, is that these are subordinated bonds that are being offered to the pension funds. What does that mean? Well, this is a unique structure in several ways. First, this is a issuance of a bond that includes the construction and the operating period. That is, the payments to the bondholders come both during the construction and the operating period. Oftentimes, project bonds are only issued once a project has been completed. When the risk of construction have been removed, the project is operating, and then project bonds are issued, usually to take out some of the debt and equity that was put in at initial financial close. In this case, here it's all been wrapped up together. The construction period is relatively brief, but like most project bonds, the interest payments are made during construction. That's because the government is making payments to the SPV as they complete the project, and then later payments as during the operating period to reimburse the SPV for their expenses. So you have a flow of interest payments and then repayment of principal after construction is completed. That is typical of project bonds. The unusual feature here is that the bonds are issued at the very beginning and do cover the construction period. Now, project bond financing is complex, even though I think it's simpler than many other forms of financing because of the nature of the financing structure being rather familiar to most people, fairly standardized in general, although the details are always very different for each project. But in this case, since this is new in Kenya for the pension funds to be investing in, the Guaranco guarantee is added. Now, it's already been suggested by Samuel that this was done to provide what I would call training wheels to the bicycle that the pension funds are going to be riding. That is, all the credit risk is taken out of this transaction and placed on the shoulders of Guaranco. The pension funds, therefore, are basically looking at, well, what are the returns and how are the returns paid and what is the stream of payments? And I will be turning that over to Gregor to briefly cover. That's already been mentioned that you will receive payments of interest during the 2-year expected construction period and then principal repayments in the future. So that's the stream of payments. And the pricing has already been discussed. It's going to be slightly better than a government debt. Although I would add, the credit risk to an international investor would be viewed as less than that of the Kenyan government's bonds. You would normally expect, therefore, the pricing to be inside that of government bonds, but that is never the case in emerging markets. In emerging markets, everything is based off of the government benchmark with an added spread, and you will have a modest added spread in this case that will be set at the time of issuance, but has already been indicated by Samuel, expected 30 basis points over government infrastructure bonds of similar duration. Now, there is, and again, I'm not going to go into the detail of what's on the slide here, of a role for the government and the consortium. You do need to know about the consortium. Information about the consortium will be supplied, has already been briefly mentioned. And all of this information has been covered by Samuel, so I will not go over it. And so at this point, I would like to turn it over to Gregor, who is going to go into the project drawdown payment profile and other issues. But again, let me emphasize, these are training wheels that are being provided by Guaranco to these bonds to introduce them to pension funds in Kenya, because you have not been involved in project financing. Typically in other countries, this is what has happened. Like in Latin America, I actually worked with some of the first project bonds in Latin America. Those were guaranteed, fully guaranteed, with full financial guarantee in many cases. That's what brought pension funds in initially. But after a while, as pension funds learn about project financing and get comfortable with it, they really do not want these bonds to be guaranteed, because then they get higher yields. Obviously, the guarantor has to take part of the yield spread on these bonds. Therefore, you get a smaller return. At some point, pension funds should be investing directly into project bonds without guarantees or with less guarantee. So here you're starting with a 100% full guarantee. It will be reduced in the future. Granco has limited capacity in each country. They're very diversified across Asia and Africa. They will not be offering a guarantee of this type on many of these projects, if any additional ones. And so this is an opportunity for pension funds to step in and begin to learn about project financing while they're being protected by Granco. Now let me turn it over to Gregor, who will carry on with this presentation. Thank you.
Thank you very much. And I'll be sharing my screen if I'm allowed to. Dan, if you'll stop sharing your screen, and then Ngatia, if you'll allow me to share my screen.
Okay, certainly.
So if you can just confirm you can see my screen.
We can.
Well, thank you very much. It's very difficult to follow a presentation by a chap such as Daniel, who both has such a long history of experience in these types of instruments, but also whose surname is Bond. So I'll do my best. What I wanted to focus on is very practical things from a pension fund. So normally in a project financing, especially a concession arrangement with a road public-private partnership, you would have a relatively long period of financing. So both a long period of construction and a long period of payback. And in some cases, these concessions can go up to 30 years and the financing can be 20 to 25 years. So the first thing to bear in mind in this instrument is that it's a relatively short-term instrument, and it's a short-term instrument for two reasons. One, it's short in the total duration. So the financing term here is only 8 years, including construction, which is quite unusual. So obviously, the longer a concession arrangement, the longer the financing arrangement to that concession arrangement, the greater the risk. But when you've got a shorter concession period, that reduces the funding risk. So normally in project financing where pension funds have been operating in the types of arrangements that we do in Europe and European PPPs, the term is generally a little bit longer. The other thing to bear in mind is for a typical bond normally pays out interest and then a bullet maturity payment at the end. So unlike a home loan, you just pay your interest and then you pay a big balloon payment at the end. Now, an amortizing bond or an infrastructure bond, anything that amortizes, you're paying some of the principal over the term of that, and you're getting both, as an investor, you're getting both the principal and the interest payments back, and that's usually done on a straight line basis. This particular project also has some peculiarities which have the result of reducing the cash flow or return risk in the project structure. And the peculiarity of this is that there's quite a large principal payment in the early years. So the question a pension fund investor might ask is, when will I get my money back? And there are two options. Either the instrument itself is liquid and traded, so you can simply sell it on the stock exchange if there's liquidity on the stock exchange, or the cash flows that you're receiving will be received in a way that matches your treasury function. Here, this is a limited liquidity bond on a private placement. There's no guarantee that you would be able to sell the instrument. But by the same token, the cash flows related to the return of funds to the investor are front-loaded. So you get a large portion of the return of the funds in year 3, which is unusual from this structure. And it, from that point of view, from a pure credit risk point of view, the earlier you get your cash flows, the lower your credit risk. In other words, even comparing to an amortizing bond, which is the benchmark pricing, you are still getting the money returned at an earlier basis, at an earlier time. So that purely from a factual credit risk point of view would make it less of a credit risk because of those funds are coming in early. And the reason for this is that there is payment by the roads agency against certain milestones during construction. That cash is held, and then what's called swept. There's a cash sweep that allows both the equity holder and the subordinated debt, which is the note holders in this case, to receive some cash early on. Let me move on to the next slide. So what is important here from a credit point of view is what credit risk are you taking? Now, we've talked about this in a little bit of detail. Garanco have given an explanation. Dan has talked about it from this point of view. But it's important to note that the credit risk that you are taking is a credit risk which is rated as AA-, which is the credit rating of Garanco. So the credit risk you are taking based on the evaluation that credit agencies do, and that is based on what their expectation of default is. So the long-term default expectation of the government of Kenya is a B, and a B means that in the very long term, over the average term of those instruments, the expectation of default of the government of Kenya would be in the region of 20% over the long term, based on a credit rating of B. A credit rating which is in the second highest, which is high grade, has a long-term expectation of default of 0.1%. So when you are 3 notches above a B or 3 notches above the government of Kenya rating, it has a large effect on the expectation of risk. In other words, the expectation of default. Now, the question is, Garanco is providing a guarantee against the note holders. Is there any legal risk of Garanco not paying out? That has been dealt with, I think. But what is important to note is where there's been an independent rating of the notes themselves, and Garanco has provided a guarantee against that note, the note has been rated at the same credit rating as Garanco. And a recent example is the syndicatum issuance in Filipino peso and Indian rupee, where the note itself had the same credit rating rated by Fitch as Garanco itself. So the expectation, even though that this isn't a rated note, is that the credit risk would be associated directly with the pass-through, the see-through to Garanco's balance sheet, and that would be the deemed credit risk of this particular interest note. The payment process is relatively simple. A payment demand is made to Garanco, and then within a period of days, Garanco pays out. As Garanco mentioned earlier, it is not an insurance product. It doesn't have a claim period, and it doesn't require any arbitral award to say that the claim is valid or that a loss, in fact, has occurred. So we talked about Garanco. We don't need to spend too much time here, but one thing that I want to point out is that the shareholders of Garanco, both in terms of the trust shareholding and the direct shareholding, the trust shareholders through the PIDGE Trust are United Kingdom, Switzerland, Australia, Sweden, Netherlands, France, Canada, and so forth, and FMO directly, are in fact both governments and institutions which subscribe to a set of principles and requirements for projects, both in project integrity and both in terms of environmental and social governance. So when a pension fund in the developed market looks at an investment, most of these pension funds have subscribed to the principles for responsible investment. They subscribe to the Equator Principles, and these are principles which govern the investments and govern investments into companies and into projects which have certain characteristics that are verified. And these characteristics fall under this environmental and social governance component or assessment. And these principles talk to both environmental and social governance within the project, but they also talk to risks. So are there any risks within that project instrument or that investment which are not purely financial risks? They are risks related to climate, for example, or risks related to social and local legislation around social governance. So the first things to point out here is within the structure of the PPP, within Kenyan law, and within the way that the PPPs are procured, there's a requirement to have an environmental and social impact assessment, which of course has been done. The second two levels of assessment are the levels of assessment that the agencies involved in the project require. And those are minimum standards that they require in order for them to participate in the project. And both Garanco and MiDA, who are currently going through a process with the project, also enforce these obligations on the project. And Garanco effectively has standards which are akin to the IFC performance standards, which set out a number of requirements, both on the environmental integrity of the project, on the sponsor integrity, but also on certain social governance components. MiDA have a even more detailed assessment process, which go through a set of activities and compliance areas. And within that process, they then create what's called an environmental and social action plan. And that action plan then determines what activities must be required by the consortium to manage the project, and what are those minimum standards that need to be accounted for and exercised within the project. And those compliance areas are quite detailed. So they deal with environmental and social risks, those impacts. They also deal with local labor conditions. They would deal with resource efficiency and pollution. They deal with community health. They deal with safety and security. They look at the way the land was acquired and whether there was any community involvement or remuneration required. They look at resettlement, which is very, very important, especially in the Kenyan context, which has caused problems in other projects historically, like the Lake Turkana transmission component. And they also then look at biodiversity. They look at indigenous communities, and they look at whether it compromises cultural heritage. And within that, if there are any areas identified, that comes out in the environmental and social action plan. So it's important to note that from a reputational risk point of view, as it relates to environmental and social governance, there have been quite a series of processes and minimum standards imposed on the project. So we've talked about the credit risk. We've talked about what pension investors look at from environmental and social governance, and we've looked at the pricing. So just in summary again, to go through these elements, pension funds do invest in infrastructure, and this has been a very fast developing type of investment. They have actually increased their allocations to infrastructure, but also they've increased their allocation to the risk. So you'll see pension funds now, specifically UK pension funds, who have formed their own type of alliances, very similar to KEPFIC, starting to invest even in equity in projects. And we've seen equity investments. And when I was with the UK Green Investment Bank, we had local pension funds, Scottish pension funds. I live in Edinburgh, which is close to where I live. And these pension funds were investing in the equity in offshore wind projects, a much higher risk profile than this particular project. But it's interesting to see that internationally, pension funds have become more and more comfortable with infrastructure investment. Normally, of course, pension funds are looking for investment grade type investment. So here you have what would be a more conservative infrastructure investment structure, given that there's a guarantee by Garanco, and given the guarantee by Garanco covers a credit rating of AA-, you've got a high grade level of credit risk associated with this investment. The other thing to mention is that when we looked at beyond the guarantor, just looking at the project itself and the security package, the types of insurances and the types of performance bonds that the contractor needs to provide, these are within international standards, and in some cases they actually exceed international standards. For example, the security package provided by the EPC in this case is much higher, 3 times higher than the international norm for this type of project. So from a structural point of view, as far as pension funds would be looking at this, this is within the bounds, if not exceeding the bounds of a normal security structure. Then again, the last thing to mention, this is very important for the World Bank Group, looking at projects, even though we don't, we're looking at this generally from how this fits into the pension fund investment world. This fits in with these minimum standards that would be normally expected and would be normally set in place in order to avoid reputational risk by the pension funds. So that's it from my side, and both Daniel and myself very happy to answer any questions relating to our presentation. Thank you.
Thank you very much, Dan and Gregor. We'll open up questions to the floor now. Raise your hand or please put them on the chat. Maybe I can summarize what I took out of your presentation. The first is that was a really good overview of project finance and the benefits that this guarantee would have within project finance. Speaking on the guarantee, Dan, you put it very well that this guarantee can be seen as training wheels, which will eventually fall off on future transactions. So this makes this a very an opportune investment to get involved in project finance. We also talked about the shorter duration of the bond, approximately 4 years, and the fact that you would be taking a higher grade or higher grade of credit risk than government, which is always good. So it looks like we're getting higher returns with lower risk, which is the best of both worlds. And finally, Gregor, to your last point, that the structuring of this bond is at a higher than international standards in many of the elements. That is all very big positives for this transaction. Again, the floor is open for any questions. We shall be sending all the presentations to everyone on this call right after this discussion. Well, if there are no questions, I think we can, we're doing very well for time. I think we can move on to the next steps and vote of thanks. And for this, I would like to introduce Mr. Kenneth Kaniu. Mr. Kaniu is the immediate former CEO of Britam Asset Management, and he's the chair of the KEPFIC Investment Committee. Mr. Kaniu is an investment professional with significant experience in Europe and East Africa across institutional and retail clients, and has a special interest in alternative assets and has grown pension fund investments into infrastructure, private equity, and real estate over the past 10 years. He sits on the board of the REIT Association of Kenya and the Kenya Advisory Board of CISI, which are very relevant industry associations and stakeholders within the pension fund sector. So over to you, Ken.
Thank you very much. I think I can see you all now. And I think good afternoon and good morning to pension fund trustees, the KEPFIC Secretariat, the steering committee members, and all the participants in today's inaugural investment series. We're actually very excited at what it is we've been able to achieve here today. I think this has been the product of a lot of planning on the part of KEPFIC, planning over the last 2 years in conjunction with our investment partners, MiDA, Cross Boundary, the World Bank, and many other stakeholders. And I want to thank all of you for your attention and for your attendance in this first investment series that has been put together by KEPFIC and by investment partners. The global idea around KEPFIC is to get more pension funds invested into alternative assets, primarily infrastructure, energy, and real estate, And that was a point that you'll all recall was articulated very well by our chairman, Sundeep. And we've heard from the retirement sector regulator this morning as well, Mr. Nzomo Mutuku, about the challenges that they have noted around diversification of investments and the kind of concentration risk they feel that we are running with respect to some of the listed investments that are out there, particularly things like government bonds and so on and so forth. I think on our side as KEPFIC, we are committed to reviewing investments. We are committed to continue to engage with project sponsors, project issuers, so as to ensure that we have a quality deal pipeline that can be made available to pension funds, to fund managers, to achieve those objectives around returns, diversification, lowering of concentration risk, and so on and so forth. Today really marks the first in our series of investment meetings where we aim to educate, to inform, and to share information, and hopefully as well to spark action with respect to investments in this asset class. Our investment criteria really is to look at brownfield investments of a debt nature to start with little to no development risk being taken. And we truly feel that this is going to allow us to build confidence over time and catalyze investments into alternative assets in the next couple of years. I think today we have reviewed and we have made available to you, our members and potential members, an investment in the Lot 3 Road Annuity program. We feel in our assessment and together with the assessment of our independent experts that this particular investment meets the criteria that we have set out for ourselves. And you have been able to see the relatively better return compared to government bonds. You've been able also to get a view of the guarantee that's coming through from Garantco that really provides a buffer against any interest or principal payment defaults. And truly here we're getting the best of both worlds. I think you've gotten a very good sense from Daniel Bond and Mr. Jones around the differences between a project bond and an infrastructure bond. And particularly in this case, we're particularly proud of one of the first project bonds being issued here in East Africa. And really here, this is a bond whose proceeds are truly targeted at the target investment here, which is the Lot 3 program. And we do anticipate the proceeds as well to be generated by this particular investment. This is fairly different from the infrastructure bonds that we have been investing in for the better part of 10 years in Kenya. Because if you do look at these infrastructure bonds, we have seen over time that the proceeds may not necessarily go towards the targeted investments. And we've also noted that the investment return may also sometimes not necessarily be generated by the investment project. So here we're talking about a targeted investment going towards a targeted project, and we are looking at specific returns being generated by this project over time. I think ours really as KEPFIC in closing is to request our trustees to begin to review this investment. We want to request pension funds to contact and engage their fund managers to begin to review the assessment of this investment and also review the suitability and the fit for each respective investment portfolio or pension fund as you may have. And I think this is a point that was fairly well articulated by the FMA chairman, Mr. Jonathan Stichbury. We are fairly keen as the KEPFIC steering committee and secretariat to begin to schedule one-on-one roadshows with the transaction advisors and the pension schemes and fund managers. And this really is with Stanbic Bank, Aramco, and other stakeholders. And the intention is to begin these meetings next week. So please contact the KEPFIC secretariat as pension fund trustees and also as managers to begin to schedule dates to hear more about this investment in greater detail for you to be able to make an assessment as to the suitability for your investment fund. We are looking at getting initial approvals, at least internally within your own schemes, by the 1st of July. Today is the 4th of June, so we're just talking of just under a month to make the assessment. And we are looking to launch or kick off the official offer period for this investment from the 1st of July to close on the 30th of July. So I do anticipate that by the end of July, we should have had fund managers and pension scheme trustees make an assessment on this investment, either yay or nay. And we will be looking to, at that particular point, begin to add up and tally up the allocations towards investment into this initial project bond. So we do feel that we do have enough time for investment and for an assessment to be made. I think as we come to a close, I want to thank everybody for participation in this first series, in our investment series. We are targeting to have more come through perhaps on a quarterly basis. So we do want to thank in attendance all the pension fund trustees and their teams who have attended today's first meeting. Thank you very much for the questions. Thank you very much for the attendance. I think it's very encouraging for us to be able to see that. And hopefully over time, we will be able to share and contribute to the body of knowledge that we do have around alternative investments. We want to thank the Stanbic Bank team, Jonathan, Robert, and the team. We want to thank Mr. Ngatia representing Garanco. Thank you very much for that presentation and for that vote of confidence and that support that Garanco is willing to offer the retirement sector in Kenya. We want to thank Mr. Nzomo Mutuku, the CEO of the RBA, for his commentary and for his support broadly of the initiatives that we are undertaking. And we are also very grateful for the presence of the FMA chair, Mr. Stichbury. He represents the fund managers during this particular meeting. And we want to continue to commit to pledge continue to pledge to work with the FMA to then ensure that we can be able to place quality deal pipeline in their hands so that they can make the requisite recommendation towards their pension funds. We want to thank our partners, beginning with the World Bank. Thank you very much, Mr. Bond and Mr. Peterson-Jones, for that wonderful presentation and for allowing us to be able to get a sense of the kind of comparative nature of what we are doing against Latin America and so on and so forth. We want to thank the Palladium team and the Kenya Investment Mechanism team for the work that they have done to get us to this particular stage. We want to thank the MiDA team as well, led by Mr. Saha, for the support that they have offered to KEPFIC over time and for the continued support that we know that we can continue to count on over time. We also want to thank the cross-boundary team led by Mr. Paul Auma and his colleagues for the support that they've also offered us in the assessment of the investments that we do have. Lastly, I want to thank the KEPFIC Secretariat, led by Ngatia and his team, for the many, many hours and days and months that they have put into ensuring that this investment series is a success, particularly this initial one. There's a lot of work that they are doing with respect to reviewing investments, due diligencing them, and presenting them to the investment committee and to the steering committee for further review. And I think today's meeting is really a testament of the kind of investments that we are looking at. And it's also a testament to the kind of criteria that we are using to ensure that we can continue to generate good pipeline on behalf of the industry. So I think mine is to thank again everyone once again for attendance and for participation. I do wish all of you a great rest of the day ahead and a great weekend. And we do look forward to engaging with you over the coming weeks and months with respect to making an investment recommendation for your pension schemes with respect to this Lot 3 program. And do look out for further invitations and further meetings of this nature to review further investments further down the line. So thank you very much, and I wish you all a good day ahead and a good weekend. Thank you. Back to you, Ngatia.
Thank you very much, Ken. I would also just like to close this discussion at this point with a quick thanks for everyone who joined us today. Thank you to the transaction teams, and thank you to the trustees and the fund managers who have joined us. Like Ken said, so we have about a month to get internal approvals done. We are ready to set up one-on-one meetings with your fund managers or directly with yourselves starting next week, please reach out to the Secretariat. I think you all have our details, and we would be happy to get this ball rolling. So once again, thank you all, and I wish you all a very good rest of your day and a good weekend. Thank you very much.